This is Barry Knapp with Ironside's Macroeconomics. It's actually Sunday morning, April 26th at 8 a.m. Mountain Time. I'm recording this a day early so I can drive down to Denver Airport, fly to Las Vegas to speak at the Deal Max conference, something we didn't know a lot about. We got asked to participate in. It's a large conference for mid-sized private equity, mergers and acquisitions type firms. Anyway, that's why this recording is coming on Sunday rather than our typical Monday morning. Our note this week was titled "Goodbye Bigfoot," and that's a reference to the Fed's larger than optimal footprint in the markets and the DOJ dropping or moving the investigation over to the IG, setting the stage for the confirmation of Kevin Warsh and end of the Powell Fed. On Saturday, the Senate Banking Committee posted that they're going to hold the vote on Wednesday, and this morning in a Sunday morning talk show, Senator Tillis confirmed that he will vote to confirm Warsh as the next Fed chair, which will move it out of committee to the full Fed floor, or full Senate floor, excuse me, which will, of course, clear the way for Warsh to be seated when Powell's term as FOMC chair ends on May 15th. That was a very positive development from our perspective. We thought that once the Trump administration had exhausted all other possibilities, they'd eventually, although it's not the administration, it's the DOJ, they'd do the right thing and clear the way to moving things along. We suspect Treasury Secretary Bessent may have been nudging the process a bit so he could get on with what we've been calling the Fed's balance sheet privatization. And so we began our note with a discussion of that. The Fed is understood going all the way back to 1951 when the Fed Treasury Accord cleared the Fed, gave them their so-called independence to move away from the fiscal dominance that had been in place from 1942 through 1951 as a consequence of the wartime financing. They were capping interest rates, so the Fed really didn't control monetary policy. Treasury did at that point. As a result of that, the Fed moved to, under Bill Martin or McChesney Martin, moved to a bills-only policy, meaning they did not hold bonds on their balance sheet for the most part. They only held Treasury bills so that they were not engaged in facilitating financing of government debt. That ended under the Bernanke Fed. They were crisis measures to buy longer-term treasuries when they lowered the policy rate to zero. Kevin Warsh supported them at that point, but he did not support, nor did we, you go back to our writings as Barclays equity strategist, the non-crisis QE that took place during QE2, Operation Twist, and again, reinvestment of mortgages, the maturity extension program, which extended the duration of the Fed's holdings all the way out to 12 years in 2011, or QE3 in 2012. And we saw the same process take place in the early 20s, where they went from providing market liquidity, these are Badge a Hut or lender of last resort type measures to stabilize markets in a crisis, which the Fed was originally founded to do, but they quickly moved to trying to use them as an economic tool, one that they purport not to understand. And they clearly, at least under the Powell Fed, don't seem to understand. As we detail, there's been a very clear impact on the pricing of longer-term treasuries, which is the discount rate for any capital expenditure or any investment in a longer duration asset. The weighted average maturity of the Fed's portfolio is 8.6 years. We can, or 5.6 years. We can give Andy Constant the credit for that. He had an excellent tweet on this or X post on this on Saturday morning. The outstanding treasury, the weighted average maturity of outstanding treasuries is 8.53. So the Fed's holdings has actually reduced that private sector weighted average maturity all the way down to 5.36 years. That's almost a half a year weighted average duration. It may not sound like much, but we assure you it is. And in fact, our work shows that it's suppressing long-term rates by somewhere around 0.5 to 0.75%. So the Fed's providing accommodation to long-term borrowers to the tune of about 0.5 point, 0.5 to 0.75%, while the policy rate is restrictive by 0.5 to 0.75%. This is unbalanced policy in our view, and we can see it in the return on equity of regional banks versus small banks, which the spread is 3%. Typically, that'd be more like 1.4%. We see it in the duration of the high yield index, which is at an all-time low, versus the IG credit index, which is more normal at around 7 years. So that spread is quite wide. Again, it's advantaging high quality borrowers, not leveraged borrowers. Small business employment versus large business employment is another manifestation of this. So this is clearly unbalanced policy. We don't understand why the Fed shrugs this off, why Powell won't discuss it, or perhaps doesn't believe it. A lot of financial reporters don't believe it. A lot of economists don't believe it. But it's there for the eyes to see. 40 years of markets observation, this is a very clear distortion of the capital allocation process. Now, the Warsh Fed is going to get started with the what we've been calling this balance sheet privatization, which includes bank deregulatory policy, reducing the liquidity requirements so they don't need to hold $3 trillion in reserves. We think the Fed should not pay interest on reserves on anything over and above what banks are required by regulations to hold. That would stop some of the liquidity hoarding, loosening of capital requirements, widening of the supplementary leverage ratio. There's a number of steps they could take that would potentially reduce the need for that $3 trillion of reserves, say take it down to $2 trillion of reserves, in which case the Fed can start reducing their asset holdings, and they surely should be reducing the duration of their asset holdings regardless of whether they move forward with the regulatory process or not. They will move forward with the regulatory process. That's going to continue for the next 3 years, and it's going to create a positive backdrop for the banking sector for the balance of the Trump presidency. So the big takeaway here is buy banks. But nevertheless, we wound up this section with one final discussion of Fed independence. And we make the point that in 2021, when Stan Druckenmiller, who was Kevin Warsh's boss for a number of years, criticized the Fed for not terming out their debt, not extending the duration of, the Treasury for not extending the duration of the debt. We would go a step further. What Treasury Secretary Yellen did was actually just pay for all those nearly $500 billion of checks that were mailed to the public as a component of the American Rescue Plan Act, ARPA, the $1.9 trillion stimulus enacted by the 117th Congress and Biden administration in 2021. She paid it out of her checking account. Mnuchin left $1.7 trillion in the Treasury General account, which is the Fed's checking account at the Fed. The Treasury checking account at the Fed. It's not that she didn't bother to extend that debt. She just paid it out of cash, basically. And so that injected some $1.5 trillion of liquidity into the system at the same time that the Fed was buying $1.5 trillion of treasuries and mortgage-backed securities in 2021, injecting a total of $3 trillion of liquidity into the system. That's not an independent Fed. That is the least dependent Fed since World War II. So when you talk about Fed independence, that to me was fiscal dominance, and that after effect of that remains because of the Fed's passive unwind of their bond holdings, passive QT, which only drained liquidity, actually extended duration and kept that duration effect in place. So Fed independence, Nah, the Powell Fed was the least independent Fed since before McChesney Martin took over the Fed in 1951. We then went on to discuss, next part of the note was the still troubling fiscal outlook. We got a question from a client, which is a totally fair question about our inflation outlook and how, we've been expecting there to be disinflation. And that is our expectation for the next year or so. But beyond that, we still have a big fiscal problem. So the rate of change of spending growth from the government has stabilized interest on the debt. It went up sharply under the Biden administration from 1.4% or so to 3.1. It's only drifted higher in the first year of the Trump presidency because government spending growth slowed from 11% in fiscal year 24 down to 3% in fiscal year 25 and is tracking 2% through the first 5 months of fiscal year 26. So that's caused that interest on the debt to slow. Ultimately, though, if government spending remains at 23% of GDP, that will reaccelerate, and you'll in essence have the Treasury borrowing money to pay interest on the debt, sort of PIK financing, and that will reaccelerate the inflationary process for sure. We then went on to discuss how not all government spending is the same in terms of its inflationary impact. So direct transfer payments, which are at 18.6% of GDP, pretty much an all-time high other than the spikes during COVID. Periods when that's been accelerating, like in the 60s and 70s when it went from 5 and change percent up to 13% under LBJ and Nixon, were inflationary. Certainly the 20s, it's been inflationary, but other periods where direct transfer payments as a percent of disposable income or GDP have slowed, then you've had disinflation. Tax expenditures it's a form of government spending, but not quite the same. So we went through a discussion about tax on tips, the no tax on overtimes, the Social Security exemptions, and how NEC Director Hassett has suggested these are supply side measures that could bring more labor supply into the market, get people to come back into the labor market who have retired, get people to work longer hours, that sort of thing. Thus far, we don't see a lot of evidence that it's really improving or increasing the supply of labor. So it looks mostly like demand stimulus. In the near term, it's offsetting the energy price spike to some extent. We saw that in last week's retail sales numbers. Net, we're still expecting disinflation through the course of the year. In the Fed survey, CNBC's Fed survey, we penciled in 2.5% CPI for the end of the year, and PCED we think will cool and go back to a discount to CPI when we get done with all these funky seasonal adjustment problems that we've written about recently. So next couple sections of the note, we wrote about hyperscaler CapEx. We can't recall when we ever had the big 4 hyperscalers all report earnings on one day, which also happens to be Fed Day. So Wednesday afternoon, and we went through our measure of CapEx to cash flow, and you can see there's a range across the various hyperscalers. Oracle doesn't report next week, but they're at 140. They're leading the league in CapEx. You have Amazon at 65, Meta at 68, Google at 52, Microsoft at 45, and Apple's not a hyperscaler, but you can see that they're only spending 8% of cash flow on CapEx. We continue to watch credit, this CapEx to cash flow or EBITDA measure, credit spreads broadly to see whether they're starting to saturate the market with all the debt financing they're going to need to build out these data centers. And then obviously the stock price reaction to CapEx announcements, which was less than positive last quarter. That'll be interesting to see how it goes this quarter. We remain long the sector. We don't think we're at the end of this trend. We're not overweight the sector because we view that as being reckless, given that tech is 35% of the S&P 500 and comm services another 9 or so, but still have a pretty healthy position in it because we do not think that this trend is complete. We wrapped it up with a little bit of discussion about how higher energy prices impact the sectors of the S&P and concluded that some 80% of the S&P be a net beneficiary of a modestly higher energy price, not an acute shortage, not $125 or $50 price, but something that were to settle in around $75, $80 or so would actually create the cash flow to help build out the infrastructure to power data centers. So in that sense, it would help tech. It would obviously help energy materials. And a higher price would help the industrial sector because it makes the U.S. a more desirable destination for manufacturing, a boost to our manufacturing renaissance that we wrote about the prior week. So that's it for me this week. Barry Knapp from Ironsides. Have a good week, everyone. We'll be back in Colorado tomorrow night. Really quick trip and sitting at our desk on Fed Day. Although the only thing we could hope for out of Fed Day this go around would be for Powell to announce he is leaving the board altogether. That to us would be a very positive announcement. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.